Chris Iggo, you're Chief Investment Officer, fixed income of Axa Investment Managers. There's been a lot of chaos and turmoil in the markets in the last couple of weeks. What's the investor sentiment in the capital markets right now?
I think investor sentiment has weakened, largely because people are worried that the very long US economic expansion is maturing, maybe coming to an end over the next year or so. They're also concerned about global growth slowing down in places like China and Europe. And also on the political side, the trade tensions with China and the fact that the US government is shut down have also weakened sentiment.
So interest rate expectations have shifted recently in the last couple of weeks. So there's a lot of speculation what the Fed does in the US. What do you think? Will they stop raising rates? Will they continue raising rates, or will they even lower rates?
I think the Fed will stop raising rates. That doesn't mean there won't be any further interest rate increases, but for the time being, the Fed is responding to the weakness in sentiment, the volatility in markets, and signs that the economy is slowing down. So I think rates are on hold for the first half of the year, with the possibility that they could be increased again in the second half of 2019. At the moment, I'm more worried about the trade issues, the government shutdown, slowdown in the rest of the world, rather than the impact of higher US interest rates. But as the yield curve tells us, normally when the Fed tightens monetary policy, there is a recession.
There's also a sharp decline in the oil price. What role does that play?
That's a negative one for the US economy. It benefits consumers, but the US is now a net oil producer, gas producer. So when prices go down, revenues to oil companies are reduced, and that has an impact on their investment plans and spending. And we've already seen this be an impact in certain parts of the United States.
Based on the turmoil we had in the last couple of weeks in the markets, a lot of asset managers now say 10-year US Treasury bonds are a safe haven asset again. What do you think about this?
Oh, I think they've certainly proved to be a safe haven, as they've performed very well when equity markets have been volatile. I think they will always continue to be. At current yields, they don't offer a great return, but 2.6% is better than you can get anywhere in Europe. So I think there'll still be strong demand for US Treasuries. I don't think the yields will go down back to the lows we saw in 2016, but somewhere around 2.5% to 3%, I think is an attractive investment.
So what other opportunities do you see in the national bond market?
I think where we're looking most to see some valuation is in emerging market bonds and also in US high yield. They're the two areas where yields have increased the most in the last 6 months. We think the fundamentals are still rather good, improving in fact in emerging markets. And given those high levels of yield, fixed income investors get a good carry, and therefore the total return should be very positive over the next 12 months.
Last question, we had interest rates of 5, 6, 7, 8% in the last, well, some 30 years ago. Do you think we'll go back to this level anytime in the future?
The only way I can see interest rates going back to those kind of levels is through an increase in inflation. And the only way I can see inflation increasing is if we have protectionism pushing up trade costs, tariffs and import prices. If we don't have that, then I expect to see inflation remain very low, and therefore interest rates remain low.
Chris, thank you very much for your time.